Good afternoon. I'm Steve Buser, and on behalf of the American Finance Association, I welcome you to today's contribution to a series of sessions that we're recording on the history of financial thought. Today is especially of interest to me because we have not one, but two guests that we're interviewing, Hal Bierman and Smidt, founding contributors to the field in a very important way, and we'll get into that in a little bit more detail. At what point did you decide you were going to do a book? You started out just talking about the topic.
We did an early journal article, and then
October 1957 Journal of Business, Capital Budgeting and the Problem of Reinvesting Cash Proceeds with Hal Bierman.
So when you actually wrote this book, you did not have a course in mind that this would be the textbook?
oh no.
No. This was,
there was no course.
It was for businessmen. It was sort of a manual that you could learn how to do capital budgeting and from the book. And then I think I started teaching a seminar at some point. I was kind of one foot in marketing and one in economics, and I knew I'd rather get more in the economics in the long run, although I enjoyed the marketing course I was teaching. And I think I ran a research seminar. We didn't have much of a PhD program then, but I think I sort of vaguely remember before it was a course, it was some kind of a seminar where we're reading articles, maybe reading some of the chapters that we were writing. I don't really remember anymore.
One thing we did shortly after writing the book is run seminars for executives, and one name in particular, Bill McEachran from Standard Oil of Indiana. I thought we had a pretty good solution to buy versus lease, and he pointed out some new complexities that we had missed. And you know, there we were in 1960, whatever, 1, 2, and this real live business person is educating us, and it was nice.
Who would come to a seminar on capital budgeting? We think, well, capital intensive industries. So we got people from the oil industry, oil especially. They were chemical engineers, and they were smart, and present value tables didn't scare them. They all knew about exponential functions, you know, from day one. The steel industry, we had one guy over maybe a decade from the steel industry, and he was the wrong guy. Nobody ever came. Occasionally a public utility guy would come. Capital intensive, they would never come. So it was sort of a mixture of other things, but it struck me the difference. I mean, the steel industry had nobody was using.
But every once in a while we'd run into somebody, a young treasurer from Swift and Company, for example, turned into Don Kelly of S-Mark.
Yeah.
And so it introduced us to some people who became very interesting. And
Wow.
I'd like to think that our 2-day seminar or 3-day seminar did something relative to
Kelly was an MBA, I'm pretty sure.
No.
No?
No. Don Kelly, no.
Well, how did you talk Macmillan into publishing your book if you had no natural audience?
Good question.
Again, it was a different world. I'm writing a book now that's going to be it's attempted to be a trade book, and it's very, very different. I think the distinction between trade and academic wasn't as great, and the guys who were coming around selling you textbooks also had a job to try to find out what you were writing, and so somebody heard about that. I don't remember that we had any trouble getting this published.
There was a young guy at Macmillan who was willing to give it a try as a trade book, so it didn't start off as a textbook. That came later.
But you were get credit for putting problems in there, which, you know, that might have been the secret that made it possible to use it as a textbook.
Yeah.
And
but
I never would have thought about that. I mean, because, you know, I'd never taught in a business school before, and, you know, economics text wouldn't necessarily have a bunch of problems. That wasn't going to be the essential thing. So that's one of the things that certainly made it possible.
But it's interesting, you know, you confessed to having used it as a text. Tom Copeland came up to me one day and said that was his text.
Apparently, a lot of people used it as a textbook in a second course. It wasn't a basic text. I mean, it's an amazing thing. I've thrown away the records now, but my rough guess is that that there were about 1 million copies were in print at one stage or another, with a little over half in English and then in the other languages. But
Japanese, by the way, were the first to translate it.
Yeah, that's very interesting. But that's pretty amazing for a book that is not a core course. I mean, for a elective course, and it never was. I mean, I don't know that was probably never used anywhere in a required course. So for an elective course in a business, and really directed at MBAs, insofar, I mean, after the first edition, that's where it went. And I looked through it, recently for the first time in decades, and well, we had a lot of the questions and some of the answers, and we were, I'm sure Hal felt the same. We were learning. I remember, say, around early '60s, thinking, well, I've been teaching now for about 10 years, and most of what I'm teaching is stuff I didn't know when I came to Cornell. So we were learning at an incredible rate. It was just a really exciting time, and I don't think we knew how exciting it was because we hadn't lived in adult time. But this, there was so much going on, and part of it was computers, and you could. Again, we didn't realize, but you could do things with numbers which you just couldn't have done before, and that became important pretty soon. And we took some courses. We both sat in on some statistics, probability and statistics courses at Cornell. Had a couple of good, and those had some great. Paul Wolfowitz's father was a professor at Cornell and was a great teacher, and there was a guy named
Jack Kiefer.
Who was one of the best teachers I've ever seen. He would go into class and fill the board up with equations and finish 2 minutes before. And one time I went to see him about getting some advice about what to do on a sabbatic leave, and I was with him for an hour before class. He never had a chance to look at his notes. He went in, the lecture was just as good. This was an amazing guy.
And a nice person.
Yeah,
so. Glad to hear that. And just so you know, I was an undergraduate, I think roughly 1967. This was the textbook for a course in...
Where was that?
Princeton.
Burt Malkiel
taught corporate finance.
Yes.
And this was the textbook for it.
For undergraduates.
For undergraduates. Oh. And I'm going to tell you that it seemed like a very natural textbook. So what you're telling me now seems very strange given my personal history. This seemed like a natural thing. The topics, the layout, it was like a textbook.
It's really...
it might have been the next edition because this is 1960. The other thing that strikes me as very interesting, and I just want to mention it briefly, is that you have extended tables at the back, and I think people that are watching this won't necessarily understand how unique and important those tables were in real time. In the mid-60s, they were important.
They were very important.
Because we didn't have computing technology.
Yes.
We didn't have calculators. We had slide rules. I used the slide rule.
Yes.
Yeah.
And to try to compute these numbers by hand, even the present value table, something as simple as that today.
When Merton Miller passed away, his wife sent me a notebook that he had that had some plastic templates that allowed you to do present value and annuity calculations that had been put out by some, I think one of the oil companies and so on. It was so hard to do that there was a way to quickly sort of beats the slide rule. Maybe it's still around the house, something like that.
Well, I wish I had that when I was.
Yeah.
And by the way, those types of things, if you have more of them, make sure you think of the American Finance Association because they would like to archive as many of those things as possible. And unfortunately, Merton Miller's wife has also passed away. So
I didn't know.
I'm thrilled that at least some of those things survived and that she's entrusted them with you.
I wonder if it survived my move and stuff.
So the capital budgeting, with the phenomenal text goes. Now it's ninth edition of that book, and it has continued to evolve. Another question I have for you: you open with the statement about the sale of Manhattan Island.
Yes.
For $24. But you point out that if the Indians had been clever enough to invest that and get 6% rate of return, that would have turned into a pretty generous amount of money by 1960. I think it was a couple $1 billion or something.
Yeah, and this is 50 years later.
I was going to say 50 years later, if they'd kept the money invested, they would probably be happier yet. Although I think people from New York would probably want to point out that the island's worth a little more than that. But they've done some reinvesting too, to be fair. So that intrigued me, that little snippet. And I noticed when you came back 50 years later, nearly 50 years later, with your advanced capital budgeting, that those little snippets became the norm. You didn't just have one; you had one for everything. Whose idea was that?
That was Hal's idea. But I must say, I'm writing a book now, and it starts. Every chapter starts out with quotations and stuff. So I've continued that. Yeah, they can be very, very interesting.
And where do you come up with those quotations?
I read the New York Times, occasional Time Magazine, Newsweek, Economist, wherever I can find
once
them.
you have the idea, I mean,
you just have to watch.
Very, very natural. I mean, I read a book now and I start underlining things that are potential quotations.
It's really fun when you find a quotation and you say, hey, that's pure gold. Obviously, if you don't have enough quotations, you stretch them a little, and
of course
some of them aren't appropriate. But on the other hand,
they were all interesting. Nobody ever complained that this was a bad quotation.
Yeah.
But in terms of content, that has evolved over time. I'm still intrigued that some of the core principles, obviously, have survived 50 years and counting. What are some of the other ideas that you think that you have learned, and you've written it very differently now? If you'd gone back to write the first edition, you would have done a little differently.
I would say that there's an important conceptual mistake in the way things are being done, but I'm not sure I know how to make it right. The theorists all do it right, and the basic theory is if you have two different cash flows that are stochastically different, that behave in a different way because of random effects, then you have to use different discount rates for them, or maybe a whole different process. We know we can't discount the cash flows from an option and get a good option value. But think about fixed costs and contribution margins. Stochastically, they're going to be very different. The fixed costs might not become fixed because of some catastrophic event, but they're mostly pretty steady, and the contribution margins are going to be very variable. They clearly ought to be discounted at different rates. So if I were teaching it today, I'd say, think about these as different rows in what we did was add up all the cash flows from one period and find one discount rate for it. And that's not the right way to do it. You would never evaluate a portfolio of stocks by using an average stock rate for the whole thing. So that's I tried to get that published. I wrote a very nice article about almost 50 years ago now, and sent it in, got some nice comments, but didn't feel it was appropriate for a journal, and I didn't. Anyways, it's never been published. But I think that's the big conceptual mistake that I would make. The other thing that I'm sort of curious about, the course is not taught as a separate standalone course hardly anymore, and I accept that. But I kind of
introductory textbooks
cover the essential things. But if you read this, there's a lot of subtlety about different situations and so on. And I wonder if anybody's learning that. And I wonder I would really like to know what capital budgeting practice is like. I have a hunch that capital budgeting became important after enough after World War II, the people were pretty sure the Great Depression that everybody expected to happen again, reoccur after World War II, didn't happen, and people were willing to take a long time horizon. I think now that the technological change is so fast that people figure out what product they do on the basis of what's technologically appropriate. In doing cash flow analysis, if you're Hewlett-Packard, years ago a guy from Hewlett-Packard said, 60% of what we are selling today didn't exist 4 years ago. So if you have really short time horizons and really rapid change, you know, it's different if you're building a power plant.
I was going to say, if you're building a dam,
Yeah.
certain eternal principles
Yeah.
apply.
Yeah, and so there's this sort of differences, but whatever it is, I wonder if the people that are doing it could know this stuff, because it took us so long to work it out. I don't think you'd figure it out. If you did the same kind of problem, you could figure out how to be good at that. But
Well, is there an innovation in terms of uncertainty with respect to the duration of the investment, so that you do it under short horizon and long horizon?
no, I mean, there's options, but
Right.
calculating real option, I mean, conceptually, we could all say what to do, but when you tell somebody
Okay.
how to calculate a real option, I've never found any happy approach on that. And so options are a big thing. That's maybe, other than what I mentioned, that's the big conceptual thing. But I don't know, in a medium-sized manufacturing plant that isn't super high-tech, where you have some technological change, but not so fast, whether people would have the ability that some of our students 20 years ago or 30 years ago had to do it in a sophisticated way, I just don't know.
Let me give a cut at the remaining problem that I see, and that is, and it's paraphrasing what Cy just said. You got time value, cash flows at time 3, time 4, and so on, and you got risk. And what we have done historically is combine time value and risk together, and we use a 8% discount rate for this asset and 9% for that. But as Cy said, the world is more complicated than that. And if you break out the cash flows period by period, it's not clear to me that there's a simple solution to that problem, other than defining a different discount rate for each investment each year, because the time is different and the risk is different each year.
And we have a different term structure and so on.
Yeah, but if you can make assumptions about the stochastic process for each investment, then you could, for each separate cash flow, then I can write down the theory for how to put it together. But I don't know how you empirically would decide what discount rate to use with a contribution margin for in a particular industry or something where probably a lot of products have similar stochastic properties. And then the investment guys, as they were saying last night at the table, you know, beta doesn't work. So, you know, we're really talking about something like beta. So there's a heck of a lot we don't understand about how the market evaluates risk.
Yeah, there are more additions to come, and
Yeah.
we're building
Yeah,
so
well,
I don't think there'll be more from us. It'll have to be another generation.
Yeah, future scholars are going to have fun with the same issues that we wrestled with, expanded a little here and there, but the same basic issues of how do you look at the benefits and compare them to the costs so that you can make a reasonably intelligent decision. And you know, I don't think the last word has been written on that.
And if you look at the different slices at this apple, different ways we've tried to address it, and some very naive, including the payback and so on, do you get the feeling that they were the best we could do at the time? I mean, before computers and so on, that payback or rate of return on investment?
I think that if a guy is smart, that even with payback, let me back up. I don't think that we convince anybody who used to use payback to do this. What we've done is train people to use present value, and they're used to it, and they get in, and that's the way they do. So they calculate payback for the guys that want to see that, and they do make their decisions with that thing. But if you were stuck with payback, you wouldn't use the same. I mean, we attack it because in the first edition, and it's a beautiful chapter that lays out, you know, but somebody would know that the payback you'd require for a project that lasts 5 years would be different than the payback you'd require for a project that lasts 50 years and stuff. And so they probably didn't make as bad mistakes as we would. But when projects get really, really complicated, you have to do it in a more systematic way. And there's no way to be very systematic about, I mean, design a dam where you've got some structure that's going to last 100 years, and some structures are going to last 50 years, and some structures are going to last 5 years, and say, what's the optimal payback for each of those and stuff. I mean, present value, but even with bad interest rates, it's going to be so much dominate.
I don't know whether you know or not, but there's a process used by private equity called cash on cash.
Yes.
And I'd like to say, well, there's one Neanderthal who uses it, but it isn't. The whole industry uses it,
Yes.
and you can't use it. You just can't. Now, you can say, well, suppose if all the assets have a life of 4 years and don't receive any interim cash flows other than at time 4. Well, yes, then you could use it. Nah, you can't do it.
No, I understand, and I wasn't really defending payback. I fully agree with that, but I'm looking at the tools for present value calculation, your tables and so on, that really opened up the door for a businessman to...
But in the utilities, they were calculating present value returns. I mean...
Well, were they using payback, though? If they had the technology, were they still using payback, you think?
No, I think the utility, because their rates were determined based on that kind of a calculation.
Okay.
And I think in the petroleum and chemical industries, 90% of the executives there were chemical engineers. They were born with a slide rule in their hands, and they could get these approximations or write continuous time differential equations. But we didn't use because the MBAs wouldn't understand it, but they know how to deal with that stuff. So.
Well, and the other is the risk evaluation technologies have improved and the option pricing technologies have improved. So even your observations that maybe your approach to discount rates would be more asset specific rather than financing specific. Do you think that's a product of the fact that we now have better ways of at least thinking about asset specific discount rates?
I think it's a combination of asset specific and financing specific. That is, the two come together.
Okay.
And unfortunately, you have to solve the problem jointly.
Yes, of course. Yes. Well, and again, I'm intrigued that you developed this as a text for businesses and executive education. I always thought of it as an undergraduate textbook, and a very good one.
Well, by the time you came along, it probably was. Remember, you were second generation.
I was second generation.
What year did you take the course in Melchior?
I think it was probably 67.
Okay.
I think it was that was about the right time. Might have been 66, but I was at Princeton between 65 and graduated in 69, so in there somewhere. And he didn't apologize for it as a textbook. He felt very comfortable using it as a textbook.
By the mid-60s, it was being used.
Yeah.
In a variety of ways. And we never got very good feedback from the publisher about where all...
Oh, Macmillan was bad.
Oh, really? I would have thought they would have been thrilled.
Well,
being adopted around the places.
Yeah, I thought so, but we got very little guidance from.
I don't know if we maybe want to talk a little bit about how we see the finance field developing. And I mean, it sort of, we came here and there was no, finance was just a descriptive discipline. People described what was happening, and there was some insight and intuition, but not very much. There's nothing, as you could say, analytically. Medignan and Miller was that. I mean, that was the first big watershed. I mean, whether you agreed with their conclusions or not, they were suddenly applying arbitrage theory that clearly was relevant and was clearly theory, and if you could get it right, that it had a strong answer, and so it had to just change the way you thought about the world, and from then on, you had efficient markets, And then, I mean, the biggest thing was option theory, because that was so different. That's like completely off the wall. From an economist's point of view, they say, where's the demand curve? I mean, how can you think about it without saying anything about demand and supply? And that it's sort of related to the efficient markets idea that there's randomness and noise that's kind of inherent in the universe, and then you use that for valuation. I mean, I think. I don't know the people that are coming at it today realize what an utter shock it was. You can perfectly understand why it took why they had a tough time publishing it, because, and nobody, I don't think, understood at the beginning how fruitful an idea. Once you got that in your head, then, you have a hammer and everything looks like a nail, and you have an option pricing theory and everything looks like an option. I mean, it's very easy to say that's all you need, isn't there? Well, it has to be a fundamental asset. You have to remind them that there's something, you have to have some basis to hang the option, the hedge portfolio on. But that was really a huge change. And then just, so that's, see, those were really, really big. And then I was interested in market microstructure almost from the beginning.
How did you decide that you were able to keep up with the option, and then we're going to do the same thing with microstructure, the option, you said this game changer for it, but yet you've incorporated it in your books, and you've...
Well, I don't know that I keep it up. We have a colleague, Bob Gero, who's, that's his specialty, and I don't keep it up with him at the level that he does. But when option pricing came out, at first it was sort of presented as a differential equation, which I had a course in, not stochastic, but I had a course in differential equations, but I wasn't very good at that. But then, Bill Sharp figured out that you could use binomial pricing. Yeah. And when you do the binomial model, all the conceptual problems are, or maybe not all, but 90% of them are there. And you can explain that to somebody who doesn't have any economics at all when you use a binomial approach.
We have a chapter about options, but if you compare the contribution of that chapter compared to the contributions that we made when we came up with sensible approaches and definitions for cash flow and different types of investment and so on, it's a magnitude difference in terms of insights. I'm not going to brag about our contributions in options. I got better things I've done than that one.
Well, but hanging in there for 50 years counts for something.
Well, yeah, no, I think we try to keep it up to date in that sense, and I won't apologize for anything about the options, but yeah, I mean, we just took ideas and say, okay, how do you apply it to
I'm not sure anybody has broken through the real option application.
Well,
if I were a dishonest business manager who wanted to get a project approved, I'd put in a real option at the termination of life, and it'd be large, and it would get the project approved. But would I sleep at night? I hope not. You know what I'm saying? Yeah. That there's too much discretion in terms of how you structure the results.
Okay.
And
fair enough.
It'd be like without options, but throwing in a terminal value that was 10 times the cash flows of each time period. Well, you'd pick that up right away. With option, you can keep it better hidden.
All right. Well, and almost 50 years after you started your first one on capital budgeting, you came out with advanced capital budgeting. You still have your original later editions of that. How did you decide to do yet another book on advanced capital budgeting?
Well, I can describe my thinking, and what I wanted to do was to keep the basic book pure. And Cy was coming up with all these ideas that were interesting, but some of them tended to be too complex compared to the basic logic of that book and its brothers and sisters through time so beautiful. It's so logical. I mean, I can give you a lecture right now without any preparation because we know it. On the complexities of the advanced book, I'd have to check my notes and check with my co-author to make sure my interpretation is right.
Part of the difference is, have you ever taught a course in capital budgeting, a whole course?
No.
Okay.
Well, not for years and years.
Have you ever? Did you ever?
Oh, I don't know.
I don't think you ever taught it. I mean, cause
probably not.
Hal knows a lot more about business subjects than I do. So for the most part, and so especially at the beginning, he'd had an MBA, and he was an accountant. And he started out as an accountant, so he has a whole kind of range of lots of things he could do. I was trying to tunnel my way into the business from economics, and so I could do this stuff because of that. And so I sort of hung on to that course for a long, long time. Part of the reason for the advanced stuff was that the stuff in that book for an MBA, for a second-year MBA course, especially when they've already had the basics, it was a challenge to make that course interesting and effective over the long term. I mean, teaching it to undergraduates who are learning economics kind of as a way to teach economics. Okay, yeah, I could see doing what Malco did, but that wasn't my situation. And the most, you know, if you had to give 1 or 2 lectures, it would teach them the idea of present value, because what we show it in that chapter, but the wrong discount rate, it still gives you powerful results. And so that's the really exciting stuff. So if you had to give 1 lecture, well, they all had that lecture and a couple more. And so now you take them up and you got to teach advanced stuff. So there's some tricky problems, like timing replacement is a really, really tricky problem. The smartest student I've ever taught took the course, and he came from a business background, I thought he's going to tell me he's going to do. My students in that course always had to do a project, so I thought I was going to get a real project from his business, and he insisted on doing the theory problem, and he took that timing of replacement and wrote an article that was so good I tried to get it published. He had other things to do, and he never actually published it, but I lectured on that, basically using his notes, and that's Frisk Johnson, who's the head of the Johnson Wax. He's probably the best. He called him an MBA. He got a PhD in applied physics, and I mean he's got a bunch of.
I think he got 5 degrees from Cornell.
But he came in and looked at it in a slightly different way. It was very nice from a theoretical approach, and really made some sense out of that. So there's some tricky things that you can do something with in there, and they were some of my pet little things that were really good lectures for 1 or 2 lectures, which Hal doesn't get excited about because he hasn't had to fill out a whole course, maybe. So
I like things that a businessman with a little bit of help, 10 minutes, can apply.
Yeah, well,
and book 1 will do that. Book 2, you're going to spend more time with it.
Going forward, you're interested in market microstructure?
Oh, no, I was interested in market microstructure for a long time. I don't know if Maureen said it, but I think I introduced her to the field. She got started and I got out at about the same time.
Okay. With that, I would like to thank you very much for participating in this interview. I've really enjoyed it and learned a lot on many dimensions, and wish you the best of luck from here on out.
Well, thank you. And Steve, I'm sure I was speaking for Cy too, that we greatly appreciate not only your efforts in coming to Cornell, but your efforts in terms of doing this entire project. I think it's a contribution to the future scholars should say, thank you, Steve.